Hello everyone, welcome back to my channel. So today is Saturday, it is August the 8th, and this video will probably be one of the longest in the entire challenge and certainly will be the longest so far. This week has been by all means a remarkable one for us. We managed to pare our losses up until this point so far, that all the way up to 51,318 euros, which translated to dollars is a little bit less than $60,000. And starting with the economic data and the world events, the week started on the right foot. Things started positively after the US declined on undertaking more attacks on Iran, and because of the apparent willingness to have a deal, and as a result of that, oil prices started to come down shortly after, basically at this point in the week, and as every so often happened, oil prices, the gold prices stabilized over here, and then they started to go up as the week progressed, and not only gold but also silver over here. And as the week progressed, we started to see that apparently more good news would be coming, because as we reached Wednesday, the ADP employment, which has been was on the previous month 95,000 jobs added in the private sector, even though there was a expectation of a lower count for this month. The job market apparently had a disappointing performance, and only 44,000 jobs in the private sector were added for July. So this propelled further not only the gold and silver, right? Because as you can see right here, everything that can bring down interest rates or prevent them from raising further will be a plus for oil and for gold and silver. And also this not so much correlation, but certainly it did not help oil, because with more subdued economic performance, there's less pressure, upward pressure on oil. Another thing that caught my attention, but also on Thursday, was that once again jobless claims went below 200,000, and this is was for me a bit of a strange development, because apparently, and over the past couple of weeks since July 11th, all the jobless claims have been coming below 200,000, which is a remarkably low number. But even though this happening, all right, and in conjunction with the ADP employment data, there seems to be some sort of dissonance between the data, because if less people are filing for jobless claims, that means that more people should be finding a job. But this the combination of lower jobless claims with lower jobs being created, and not only that, but here the job openings remained stagnant, and keeping in mind that there's a slightly reduction from the previous month, from 7.5 million to 7.4 million, which came in line. Right off the bat, it appears to me that there may be a continuation of the previous months when it comes to the reduction of the labor force, meaning more people are just dropping out of the labor force, either due to retirement or simply because they are discouraged enough not to look for another job anymore. And this continued to play a role in the upward pressure on the prices of gold and silver, which was of course all good for us, even though here on Thursday there was a bit of a blip, so it did not rise that much. But then at this point in time, we needed a bit more of an impulse because of the pricing of our calls and the way the share prices that we were holding. We needed another impulse, and right on cue on Friday, this impulse came. It was quite strange for me, the fact that we were going to have the jobs report coming, and there was the expectation of 83,000 jobs. So keep in mind, now here it was 20,000, but it was not the case. It was far higher. It was about 50,000 something jobs created in the previous month. All right. And so there was an expectation of there would be more jobs having been created across the entire economy. But even though this would put additional pressure on interest rates to go up because of the job market being more vibrant, there'd be more inflation pressures and would entice the Fed to raise interest rates. Gold and silver went up again strongly pre-market. So before the jobs report, the main ETFs that we were holding, GDX, GDXJ, were already up about 3% even before the jobs report. I don't know if there was some sort of insider trading, if some people were already aware of what was going to come, but it looked a bit strange to me. And sure enough, the situation that turned out to be was very positive for us, but again raised suspicions of possible, for me at least, possible advanced knowledge of what was going to come, because the jobs report came out, 23,000 jobs were slashed. I don't think this figure is as bad as it looks, and we are going to have a look at the jobs report itself, and I'm going to show why I think it's not that bad. But still, this basically played a role of bringing gold and silver prices even further higher for the day. And as a result of that, we ended up being a sign on our GDX and GDXJ shares, but we'll get to that. Looking now at the impact of this report, and along with everything that went on over this week, the probabilities for the next an interest rate hike at the next Fed meeting on September 16 came down. Now they are less likely to occur. That is simply keeping interest rates the same. It's a bit still 50-50, but on the other hand, it's still very early days. We are on August the 8th, so we are about five and a half weeks away from the next meeting. So there's plenty of data to come, and of course, the jobs report for August, more inflation data will come before this meeting, so for sure this will change until then. But looking here at the jobs report, and this is something that the transition of material is embargoed until 8:30 Eastern time on Friday. I'm almost sure that someone got advanced knowledge and traded on this information, but that's another story. Again, 23,000 jobs slashed. The unemployment rate came down from 4.2 to 4.1. So again, labor force continue to shrink, and this is not a good development, especially now that the United States are taking a more restrictive stance on immigration. So nothing in favor or against the policy being taken, but this is a consequence of the actions that are being taken by this administration to further curb immigration. And now we see here, and this was the biggest one that came out of this jobs report, which is around here. There were not only 23,000 jobs slashed, but there were some heavy revisions, especially for May. The initial report came out 129,000 jobs being added for May. This was the initial report, and there was all across the media that the job market in the United States was very healthy, very, very sound, but apparently it came down by half, so from 129,000, and in fact the actual figure was only 63,000 jobs added. The June report was revised down from 57,000 jobs added to the 20,000 that you were able to see here. All right. And by the way, another point to make: 44,000 jobs for the private sector. This is the lowest figure since January. So there are reasons to be concerned about the jobs market in the US, because it's working under a much more subdued performance that anyone would probably have expected at this point. And again, like we saw, 23,000 jobs slashed. But again, I'm going to show you, I don't think this figure is as bad as it looks at first glance, because we are looking here at the data again. This is concerning. Labor force continues to drop down. You see here, we are now dipping further below 170 million people in the labor force. Participation rate continued to drop from 61.5% to 61.4%. That is the reason why unemployment rate came down from 4.2 to 4.1, because you have less people being employed, all right? The employment rate continues to come down, less people being employed, but there are more people dropping out of the labor force. And this month we finally crossed the 106 million barrier, all right? Either due to retirement, either due because people are discouraged and don't want to look for work anymore. Whatever that the reason be, this is something that is concerning, because there is labor that is not being replaced in the economy. And of course, if we keep this long enough, unless there is some technological development such as AI that will compensate for this loss of labor, the economic performance of the United States will not go in the right direction. Again, this is where I think it's not that bad, because again, 23,000 jobs slashed. I'm going to push this a little bit with a bit more zoom. Now, what you see here is that where these 23,000 jobs overall came out, we lost 53,000 jobs in the government. Of course, less paychecks being paid out, but this means that there are also less of a need to tax the citizens, and this will help not to expand not only the deficit, the public deficit of the United States, which is already extremely large, and the public debt, which is even larger. So this is a good development. Apparently there was already a continuation from June, when we lost 10,000 jobs in the government. Also, we need to keep in mind leisure and hospitality, another 40,000 jobs slashed. I can understand that this may be probably because of the World Cup. This is seasonally adjusted data, but still, this does not account for one-off events such as the World Cup. So this is only a compensation from the hiring that must have been done because of the World Cup. So this is not that a serious issue. Again, leading the way, healthcare and social assistance, a less of a productive element or productive work in the economy leading the way. Professional business services, this is good because these are more value adding and continue to grow. Financial activities, this is bad, of course, because they are also a very productive sector of the economy, and it's continued to slash jobs as it happens over the past couple of months. But again, looking at the rest, the rest I think pretty much offset itself. There is an increase in construction, which is a good thing to bring the cost of housing further down. There may be also some AI data center build out involved in this construction. So apparently this is also a good development. But again, this 23,000 jobs slashed came from sources which are good, either good to be slashed, which is the government, and 40,000, which is only a compensation of the hiring that happened because of a one-off event. So I would not be too concerned about this particular performance. But again, if we take into account only the headline number, this will be a point in favor not to raise interest rates further, which of course helps the metals. And again, this is what we are looking for. It sounds a bit bad that we are waiting for bad news, because bad news helps our positions. But again, this is the way we played out, and yeah, that's the way it is. Now, on to the next week, and even though it was all rosy and all sunshines and rainbows this week, I don't think this is going to be the way next week. Next week we are going to have a big week, because you see here for next week we're going to have CPI on Wednesday, and we are going to have PPI on Thursday. Keep in mind that we're going to have retail sales, but this is not very significant. Keep in mind that if we look here over 1 month behind, we had a very large escalade of the oil prices in July. So for sure, the CPI and the PPI will come more, or I expect it to be more aggravated for July. You can already see here that, for example, the consumer price index here for the month is going to come out, is expected not to be negative anymore, but expected to be positive, even though here the figures for the year are more or less offset each other. But again, core CPI from 0 to 0.3, so there's already some expectation of an increase in the rate of inflation. And again, is expected the PPI coming from negative into positive, and the core the same, from 0.1 to 0.3. So I'm expecting again that the data will not be as good, and this should hurt our positions, even though we had a apparently lousy jobs report. Now, when it comes to the trades themselves, we're going to have to look here. We did not do anything particularly different from what we used to do. We were caught up in a situation where we sold our calls right before prices started to escalate, and so we sold these $26 strike calls again, because $26 is our break even for the SILJ. All right, you can see here, but very shortly after, prices started to escalate, and now we are sitting in a situation in which we have, and to compound things further, because the prices were so low at the start of Monday, looking here at the price for the week. So as you can see here, we had a continuous escalation of the SILJ, all right, and with a lot of gaps. We were here at the 26 strike price, so you can see by Tuesday we were already at the strike, but the prices continued to escalate. And to compound things further, because the premiums were so low at the time, the stock price, the share price was around 20 something, 23 I think. Yes, it was around 23, 24. So because the premium were so low, it was so little, I decided to go ahead and sell a 2-week call option. And because of that, now we are sitting at a large unrealized loss on this call, because these calls are pretty much in the money. But we're going to have to keep it until next week, which is when these options expire, and then we'll get rid of these shares and we'll get our money back. And we are going to break even on that for good measure. So this is a situation which is not optimal, especially because, again, CPI and PPI are coming, so I expect a pullback. Maybe we already created the margin which is big enough so that even though we have a pullback, we won't reach this $26 strike price. But again, if that happens, we may have to keep our shares for even longer than this. So again, we'll see. We had our calls for the GDX and the GDXJ also expiring, expiring this week, and we managed to sell. We were still very much on the edge when it comes to actually whether we would be able to sell our shares through the calls before Friday, but then with the jobs report that came out, it was pretty much the nail in the coffin, and we were able to sell the shares. We sold the shares at the GDX shares at the price at 86, and you see here our cost bases were 85.50. So we still managed to get a $300 capital gain. Again, only 400 shares are here. The other 200 were in our Emirati account, and now I'll be able to show you that. Same thing with the GDXJ. We had 200 shares on our Emirati account, and we managed to sell all of these, the whole 1,000 shares at 115. Our cost bases were at 114, and so we managed to get a 1,000 capital gain on this, which is of course quite positive. I was already thinking, well, maybe this, of course, before Friday, maybe we'll be able to roll down our calls, buying back the $115 strike price, and sell again the 114, so that we could break even, but at least guarantee that we would be able to sell the shares. But because of the jobs report, it was not really necessary. The price continued to escalate into the 117th. You see here, so even at a $117 strike price, we would be assigned. And the same thing happened with the GDX. The GDX went 8% on the day almost. Even a 89 strike call, I think, would be enough. But again, we sold only the 86. We left some money on the table, but again, no harm done. And we also did the following, because we still had some puts on the GDX, these $74 puts, but because it became very apparent that these shares would go away, we would be able to sell them. I decided, all right, 10-15 minutes before the session, we are going to buy this back, and because there's no need for us to hold or to be more exposed to GDX, we bought this back. We bought this one back, this put on the SILJ with a $22 strike price. Again, all of these expiring next week, and we just went ahead and we are going to start to work on whatever we have left, which is the IAU and the SLV. Again, this situation means that we have 3 puts right here. You will be able to see that I also did the same in our Emirati account. I sold 2 more puts with a 79 strike price. If by chance the price of IAU comes down to below 79, we will be able to bring our cost basis down from 84.25 to 82.23, which is a bit more comfortable. But of course, the price needs to cooperate. Otherwise, we are a bit in the middle of a no man's land. This will be quite difficult for us to get rid of, because the option chain is not deep, and we are already 800 shares in. So every additional puts that we sell and eventually getting a sign, we're not going to be able to make much of a dent. in our cost basis, because for two reasons: because we already have quite a lot of shares, and also because the option chain is not deep, so we cannot dive further out of the money because there are simply no options available. And the SLV, we continue with the same situation. We have now 110,000, almost 111,000 euros to sell puts. So again, we are going to simply throw everything, the kitchen sink, as they say, to SLV. I've already made a few calculations over here of what should be the allocation, what should be the strike price, so we can bring our cost basis further down. But yeah, also try to take some advantage of the fact that maybe the prices will come down next week because of the inflation data. But again, we will see. Now, as things stand at the moment, I think this is it for our European account. Now we managed to get rid of two of those, GDX and GDXJ. Maybe this will be a done deal too, the SILJ, and if that is the case for next week, only two of them remain, which will be the hardest ones to get rid of, the IAU and the SLV. But nonetheless, it was a very good week. Let's now move to our Emirati account so we can see what went on over there. And so here we are in our Emirati account. You can see here that we managed to again sell our remainder shares of the GDX and GDXJ. Same prices, 86 for the GDX, 115 for the GDXJ. Accounting, of course, putting together the gains and losses of both the accounts, we managed to come out with a $300 capital gain for the GDX and $1,000 for the GDXJ. Same thing that we mentioned for the European account. We used the proceeds from the puts that we had online that we bought back, because we had one put on the GDXJ just before the end of the session. You see that these puts were bought back 5 minutes before the session ended on yesterday. The 74 put and the 97 put on GDXJ, we bought those back because we do not want to have any more exposure on that, and we used the buying power that we had available to sell two puts on IAU. And now where we stand with this means that we have now $42,000. These are in dollars, by the way. We have $42,000 extra because of the proceeds from the shares, and now we are going to do everything all over again. We're going to sell more puts, maybe not on the IAU, but this money will be used to sell more puts on the SLV, because we need to throw everything we have on that particular ETF so that we can start trying to get rid of it as soon as we possibly can. Now, I did not show, but I can do that now, looking here where all these calculations came from. I'm going to filter here for the GDX, and you can see right here, this is the first time since May that we managed to sell some shares. Putting everything together, this is for the GDX. So we can see here we sold 600 shares, which were the shares over here. Let's see where they are. Yeah, so these ones over here. We sold these ones, these 400 shares that we bought at 91.50. So we had a loss on these 400 shares that we had, all right, that we held for longest. And then, because of that, we had on these shares a loss net of the premiums of a little bit more than 1,000. But then we had a bigger gain in here with these 100 shares that we bought at 74 and these 100 shares that we bought at 73. And you can see here that it was only one contract for each, but we had a gain on these shares bought at 74 of 1,200 and 100 dollars more on the ones that we bought at 73. And so putting all of this together, 2,500 minus 2,200, we had a capital gain of 300 dollars. And then calculating all the premiums from these, we had premiums collected of $1,349 dollars, which brings us our grand total to $1,649 dollars and a little bit more than that. Looking now at our GDXJ shares, things were a little bit better, which is normal because GDXJ, the shares are more valuable. It's a more volatile ETF, so premiums are always more generous, but that's the reason why. And now you see here, we bought 400 shares at 122, all right, and now we sold the shares at 115, so we had a $2,800 loss on these 400 shares. We had 300 shares that we bought at 121, which we sold at 115. Again, another loss, 1,800. This loss was completely offset by the 100 shares that we bought at 97, which are over here. So we got $1,800 gain, which offset this 1,800 over here. And again, we had 200 shares that we bought at 96 each, which compounded by which we sold at 115. So we had $3,800 gain on these ones, which offset the $2,800 that we had lost previously. So we had a capital gain of 1,000. Looking at the tranches of the shares, we had on these 400 shares, net of the premiums, a little bit more than $1,000 loss. On the 300 shares that we sold, we bought at 121, we had a loss of $573 with the premiums included. And then we had this gain of almost 6,000 on these shares, including the premiums, capital gain and the premiums together. And this accounts for the entirety of the premiums, which were almost $3,400, which compounding or adding to the $1,000 gain, this gave us a gain, premiums and capital of almost $4,000. Now, for the next thing, again, like I mentioned, we are not going to sell more puts on GDX and GDXJ. We are going to wait until the SILJ is either sold, or if we have to keep the shares, we're going to sell calls again. I don't see the price of the SILJ coming back to around 23 or 22, so we're not going to sell more puts on that. We are going to wait, see what we can do with those shares, and of course eventually sell them. Now all our efforts will be on IAU and SLV. We have, again, like I mentioned, a little bit more than $42,000 to work with in this account. And at the end, when we get rid of all the shares, that will be a good time to merge both accounts into this one, because again, we are going to work exclusively with this one moving forward. For the time being, this is all. Feel free to leave your comments in the comment section down below. I'm also available on LinkedIn in case you need to ask me any questions. And as always, feel free to like the video and subscribe to the channel. and we'll reconvene next week. I'll see you there.